The state of the rally with the biggest week of this early year now in the books. Did the Bulls get a leg up, the one they were looking for? Let's ask John Mowrey. He's NFJ Group's Chief Investment Officer with me here at Post 9. You are one of the Bulls.
I am a Bull.
Did you get a leg up this week?
This is what we expected. There were a handful of things that were really culminating in the rally that we've seen. At the end of last year, you had the highest cash balances on mutual funds on record. You had the most people calling for a recession since 20, okay, and this since 2011. You had commercial hedgers, the most short equity futures going back to 2011, Operation Twist, as well as 09. So sentiment was washed out.
So you're playing the contrarian card.
Well, nobody wanted these equities, and everyone was just dumping them. And we very much believe that everything should be dictated by your next best alternative. Defense costs a lot, and it was costing a lot last year. The same way that buying hurricane insurance after the hurricane hit doesn't make a lot of sense. So we didn't really believe that the valuations in the defensive areas warranted positioning. So it was an easy decision for us to move into areas that looked very attractive, Scott.
Isn't it too early to declare victory just yet? I mean, earnings are still not great.
I think we've got some oak trees growing here. So if you think about home builders, those bottomed 6 months ago now. I mean, Pulte is beating the S&P by 20%.
A lot of people I know are pointing out what's happening in the home builders.
So these are signs, you can't always see it below the surface, but once you see these things start popping up, they become more apparent. So when we look at cyclicals, we think that there is a real turn that is occurring. And it's not just home builders, it's industrials, it's healthcare technology, it's industrials, semi-stocks. All these areas, Scott, were completely washed out. Nobody wanted them. The same thing with emerging markets.
Well, we'll get there in a second.
Okay.
Do you think that Powell was friendly to you this week, or was he misunderstood by the markets?
I think that Powell is doing a good job given where he is, and I think that, again, it's less important at this stage because inflation is rolling over. They've already raised rates significantly. Maybe we get to 5, but the reality is if you look at what happened in 94, Scott, that was the beginning of a rate hiking cycle. We got the Fed funds rate up to 6.5, and the market ripped from 95 to the end of 99.
So you're telling me it doesn't matter if they raise again in March and then they go again after that, it doesn't matter?
I think the market's telling you it doesn't matter.
Well, the market doesn't think they're going to do it. But I had Richard Fisher, former Dallas Fed president, today on Halftime Report says the market's wrong. And the market continues to tell, or the Fed continues to tell the market that it's wrong.
Well, again, I would pivot back to the 1980s. And you saw a very similar scenario. Inflation was high. The Fed jacked up the short-term rates, the yield curve was deeply inverted, and then in the subsequent 2 years after 1980, the market was up 50%. Over the next 10 years, it was up 400. So it's not that I think that they're wrong. It's just that I think the market already sees through this. I mean, the 10 years at 3.5, everyone was panicked that they weren't going to be able to refinance debt. REITs, all these other companies. 3.5 is easy to refinance.
Yeah, but the market's saying that there's going to be a cut. You really think there's going to be a cut this year?
I actually don't know if the market's saying there'll be a cut.
Does it matter? Well, does it matter to your thesis if there is?
No.
Does there have to be?
No. It does not matter. And the reason is because the valuations are at such rock bottom levels. You have Stanley Black & Decker, Scott, with yields over where they were in March of 09. You had significant dislocations that occurred. I mean, think about, I'll use a real estate analogy. Imagine if everyone on your block said, hey, rates are going to go up. That's going to take the cost of capital up. So let's all sell our house at the exact same time. That would create a massive dislocation. But we don't have a Dow Jones Industrial Average of home prices. Okay? When you inject liquidity into the system, that creates panic. And I think that people conflate liquidity and risk. And the reality is the fundamentals of many of these companies had not deteriorated to the degree that people were selling them.
So where are we going from here then?
Higher.
How much higher?
Well, you can't annualize this month and extrapolate that. That's impossible. But the markets are cruel. They could pause, they could shed a little bit, and then consolidate and move higher. So we have a long way to go with a lot of cyclicals. They were blasted, Scott. You had these things down 50, 60%. Some of them were garbage. Some of them didn't earn money. The reality is you shouldn't chase defensives, and you shouldn't chase the hot dots that didn't earn any money. But those high-quality companies.